Good morning, everyone. Week 8, good to be here as always. Second lecture of this week. We've only just sort of begun on this particular topic. I can't see, there's like about 50 slides. I can't see myself getting through all of those in today's lecture. So I'm comfortable with the fact that we can sort of push over the remainder of this topic until next week. That won't be an issue. Of course, all the stuff that's in today's material, that stuff is stuff that's going to be assessed in the final exam. So we've got plenty of time over the rest of the course to get through everything we need. Now, assessments, there is one next week. I told you a couple of weeks ago what the questions would be. Just over the last, about 2 days ago, people started sending me queries. Can I have more practice examples, those sort of things. So last night I put up, I was actually going to use that as a release for practice for the final exam, was my intention originally, but people wanted more practice examples. So there are a few examples in there of money market hedges, so that might be useful to you to have a look at, just the first couple of questions in that document that I released on LMS. You'll find it in the week 7 because it ties into the week 7 material, so have a look at that, at the additional questions, and the solutions are there. And of course, the solutions for tutorial 7, they always get released at 2 o'clock on the Friday, so you'll get those this afternoon. Okay, so just have a look through, and that should assist. Now, so remember that, and remember to go to your tutorial next week. Okay, global financing. Now, what we began in the prior lecture was looking at raising capital internationally, as opposed to just purely domestically, and so some of the motivations for that essentially came down to whether or not we could affect our cost of capital, which is the opportunity cost when we are making our investments. Discussed briefly on segmented and integrated markets. We'll come back to that more in the future when we look at the cost of capital specifically. I'll come back to that. We talked about the raising equity capital internationally, and I pointed out to you that when we raise equity capital, you can raise it privately or publicly, but we can also raise it within the domestic market or within the international markets, or a combination of the two. When capital is raised on international markets, you can have direct listings, so that's a direct listing onto a foreign exchange, but you can also have an indirect listing onto a foreign exchange. An example of that are depository receipts. In the US, they're called ADRs, and that's where a portion of your securities is packaged up and sold onto the overseas exchange, and then they can be traded. Now, with something like an ADR, US shareholders, US shares tend to have higher share prices than, say, Australian share prices. So what would happen typically is that you might, for example, you buy one of these ADRs and you're buying 5 of the equivalent Australian shares. You're buying a package of that, and so that it's share prices which are more familiar, say, to US investors. Now, an example of that, of an ADR which was issued a few years ago, which has sort of been in the news again recently because of the second issue I had there, but there's a few things that you could read on these. And here all I was showing you was that with ADRs, there are different types of ADRs, okay? And the level 1 and the 144As, they were the private markets, so the over-the-counter or a small private exchange. But what I wanted to show you was for the level 2 and level 3, these were ADRs, so where these packages of securities are sold onto the large public exchanges in the US. There is a necessity there for the firm to commit to comply with SEC disclosure requirements, and also to release statements which comply with US accounting standards. Now, this is where we ended, and what I wanted to show you here was that some evidence in terms of the effect of an ADR issue. And what these authors did was that and you'll see the reference for it here on the next slide, but what these authors did was they looked at firms which were announcing that they were going to be setting up an ADR program. So it's international firms outside the US, they've announced, we will be setting up an ADR program. At the time of the announcement, this is an event study, so day 0 is the time of the announcement, not the time of the issue. It's the time that announced that they are going to be setting up the program. There is an abnormal return, which is positive and which is significant at the time. Now, an abnormal return is a return over and above a normal return. So the way an event study works, and this is just plotting out relative to the event day. So the way an event study works is you'll need some sort of model which would generate, from which you could calculate what the normal return for the security is, and then if you look at the actual return in the market and compare it to the normal return, as derived from your model, then the difference between the two is the abnormal return. And these are the abnormal returns relative to the event day. Okay, now what model you use doesn't matter too much here, but we could, for example, we could use a single factor model like a CAPM or a multi-factor model. Not too fussed about that at this point, just pointing out that what these authors found, there was a large significant abnormal return at the time of the announcement. And not only that, it didn't just spike and come back down, because these are cumulative abnormal returns that's been plotted here. So if it just spiked and came back down, that would just be an overreaction to the news. No, it spiked and it remained high at that point in time. So there was something which was perceived to be some form of benefit at the time of the announcement. That was related to, we see here the size of that abnormal move was larger for firms which were coming, you can see in panel B, from emerging markets. You can see in panel A that it was larger for firms which were listing on the large public exchanges in the US, and it was also larger, you can see there down the bottom, when it was coming from developed countries. And you can see on panel D there, you can see that it was larger when they were listing on the large public exchanges in the US. So we could hypothesize why we might find those results. We'll see that in a moment. This isn't a test, this is just an observation. This is just classifying it and saying, okay, hey, it looks larger when it comes from an emerging market. Hey, it's larger when they list on a public exchange. If we want to test it, we could run some regression and see if there's some relationship here. And when they run these, one thing worth noting here is that it's obviously, if you look across the third row there, it's obviously significantly related. The stars represent significance. It's significantly positively related to listing on a large US exchange, like the New York Stock Exchange or NASDAQ. You can see that when they add in regression 2, when they add in a factor for emerging markets, that was significant. But when they add in a factor for if it's overcoming barriers to capital flows, direct barriers, that's the restrictions term. So when that term is added in regression 3, the model doesn't improve, the R squared stays the same, and that factor wasn't significant. So that's not really consistent with this idea that we're overcoming direct barriers to capital flows. So perhaps what's happening here is overcoming indirect barriers to capital flow. And last time I discussed with you here, when we look at the imperfections in terms of market segmentation, when we're overcoming those barriers, if there is market segmentation, so that was when we had differences in reward to risk ratios across markets, there needs to be some form of imperfection which allows that to continue. It can be a direct barrier, the government just preventing capital from flowing, or an indirect barrier. Investors are just simply unprepared. Even though they are unprepared to invest in a particular market. It effectively segments that market from the rest of the world. All right, so going to here. This table 6, just as the last table here, this one was, it's a subsequent, let's say, of these firms that had the announcement that there was going to be a depository receipt program set up and there was an abnormal return, there's a subset of those firms which initially said, okay, we're going to set up a level 1 ADR. And then subsequently made a second announcement which was, no, we've changed our mind. We're going to move it, upgrade it from a level 1 to a level 2 or a level 3 ADR. So this second one here, table 6, this is an upgrade of the ADR from a 1 to either a 2 or a 3. And the difference is, what's the difference? Well, if we go back here, you can see the difference is, firstly, you list on a larger exchange, but secondly, the firm has to comply with US accounting and disclosure requirements, so SEC disclosure and US accounting standards. So, possible interpretation of that is that one, what we see here is perhaps the additional liquidity, perhaps that's beneficial, so listing on a large public exchange, there's more liquidity for the security, more demand for the security. If that's pushing up the price, maybe that's why we're seeing an abnormal return. But it's also consistent with the hypothesis that perhaps the market here is seeing some form of benefit from the firm agreeing to comply with US accounting and US disclosure requirements. Perhaps that's beneficial as well. Perhaps it's a combination of the two. You can't distinguish, you can't pull out one or the other here for this set of firms because both those things are happening at once. All right, international money market. Now, I want to introduce this here. So in terms of reading the international money market, it was one of the earlier chapters in the book, chapter 3 maybe. But anyway, go back and read on the international money market. But look, the point is corporations or governments need short-term funds denominated in currency different from their home currency. Where do they get that from? Well, they can get that from the money market. And a money market, you can see definition there, is just facilitating or allowing the transfer from surplus units there so they can transfer funds to deficit units. That's what the money market's allowing to do. Now, so the capital market is the long end of the market. It's bond issues, it's share issues. That's the capital market. All right? Well, the money market's the short end of the market, and so we're just allowing the transfer of funds. So short durations tends to be smaller amounts. Now, the European money market, that was the original one which developed. So the European money market, you can see there are dollar deposits in banks in Europe and other continents. They're called euro dollars or euro currency as a part of the international money market. And that developed in the 60s and 70s, and there's also an Asian money market you can see down the bottom there. So I want to, now there's some terminology there that's not clear. Suddenly they've introduced the terms euro dollars and euro currency. So let's talk about that. Okay. So euro currencies. When we are referring to euro currencies or euro anything, okay, this is not referring to the currency, the euro. Okay, we are using euro as a prefix. And when you use euro as a prefix, okay, what does it mean? It means outside of the country which issues the currency of denomination. Okay, so when euro is used as a prefix, that's what it means. So a euro dollar is a dollar outside the US. Okay, so it's a dollar deposited at a bank in Europe. You could have euro dollars, you could have euro yen, you could have euro euros. It would be euros outside of Europe. Okay, so a euro currency is a time deposit in a bank account located outside the banking regulations of the country which issues the currency, and this is a market which is facilitated by commercial banks. Commercial banks allow these funds to be created. So understand that euro currencies, they're not bought and sold. Euro currencies are created through a chain of transactions. They are created by financial institutions. Now, the example I've got of a euro currency down the bottom here, if we had a firm and it has a deposit in a US bank, so it's US dollars deposited in a US bank, okay? That firm could then transfer ownership of that deposit to a UK bank. So now what happens? Now we have a chain because the firm has a claim, they have an asset claim over the bank in the UK. The UK has a liability to the firm, the UK bank has a liability to the firm and now holds the asset, which is the US dollars deposited in the US bank. So now there's a chain of transactions. Okay, that's a euro currency, so they are created. The US dollars haven't moved. They're still sitting in the bank in the US. It's just that they are now held by a UK bank, which then owes those to the firm, to the original firm that had it. They've now created euro currency. There's no physical currency that's being created as such, but this chain has been created. Now, the point being, through this series of transactions, or through this chain of transactions created by financial institutions, now, when that firm wants to pay for something, all they have to do is one way that they can pay for those goods, if they want to pay in US dollars, they can simply transfer the claim over the UK bank to another firm. Okay? And this is outside the banking regulations of the US. Okay? From the US's perspective, all they can see is that a UK bank holds a US dollar deposit in a US bank. Who ultimately owns those is outside the banking regulations of the US. Now, this type of transaction has been around for a while. The typical story for this is that at the end of, well, at the time of the Cold War, okay, end of the Second World War, at the time of the Cold War, US dollar deposits were needed. Okay? US dollar deposits are needed, and I've talked about this before, because US dollars are the currency of choice Okay, certainly in that post-World War II era, after the Bretton Woods agreement was set up, and US dollars being the most liquid currency are needed to pay for example, pay for oil, pay for other commodities. They are priced in US dollars. And so Eastern European countries, so Soviet bloc countries, needed US dollars. Now they did not want to put their US dollars in US banks. So Moscow Bank of London began to take US dollar deposits. Okay, and so they're held outside of the US because they were concerned that the US government would just simply seize and just secure those, if anything happened, that those deposits would just be frozen in the US. Okay, so those US dollar deposits are being held outside of the US. Now that market grew, and then there was a series of events which caused that market to grow even larger. There was, at one point in time, the US put in place interest rate restrictions, so there was caps on interest rates that could be paid. Well, money was just shifted offshore, where they couldn't control what interest rates were being used. More US dollars was shifted into the euro currency market, so euro dollar market. There was a time when the UK was worried about the loss in the value of the pound, and so they put restrictions on all of their banks that they couldn't lend out pounds. They couldn't, in terms of, there was restrictions in the amount of pounds that they could lend out in terms of being transferred, but they didn't place any restrictions on their banks in terms of US dollar lending. And so once again, the UK banks that were setting up this type of institution, this type of facility grew in size quite rapidly. Now, the advantage of this type of issue is that it's outside the banking regulations. So if the UK bank is heavily regulated in terms of their ability to lend pounds, they'll have things like capital adequacy ratios, they'll have things like insurances required on the lending that they make. There isn't the same level of regulation when they start lending currencies other than pounds. The regulatory system is much lower. Okay? So the costs are lower in this market because the banks are not as heavily regulated. And so with the costs lower, spreads can be inside the domestic spread. Okay, what do I mean by that? There is a domestic spread. There is an investing rate and there's a borrowing rate, and there's a spread between the two. Okay? So if I invest, I'll be lucky, I might get 1%. Okay? If I borrow, I might be able to borrow at 4 or 5%. There's a spread between the two. In the euro currency market, where the regulations are lower, the spread can actually sit within the domestic spread. So you can offer higher deposit rates and the borrowing rates can be lower because the costs are lower. And so that provides an incentive then for firms to raise capital within the euro currency markets, whether it be through debt or equity issues. Now, if we're looking at the euro currency markets, so we could have a euro equity issue. It's a form of international equity issue. Now typically with euro currencies, these types of issues are not so much used with equity. They tend to be used for debt financing rather than equity financing. But you can have euro equity issues, and an example of that which began was the privatisation of British Telecom, because when that was privatised, it was seen as being too large for the UK market. It wasn't going to be able to absorb the privatisation. So those securities were sold simultaneously domestically and offshore. So pounds were raised outside and pounds were raised within the domestic market as well. I mean, it turned out at the time they underpriced it and it was a big win for everybody who purchased it at the time. But remember that when we're dealing with euro currencies, it's a market which is created by financial institutions. Because it is offshore, the costs are lower. It is an unregulated market. All right. That's equity financing. So broadly, equity financing. Public or private issues. Okay? It can be international, it can be domestic, or it can be a combination of the two. All right. Understand the different forms. Understand that when you have an international equity issue, it can be directly issued onto an overseas market. They tend to be heavily regulated. It can be indirectly, and so it's cheaper for an Australian firm to indirectly list on the US exchange. So they keep their primary listing here in Australia. Those securities are packaged up and sold as a depository receipt into the overseas market. There's less regulatory hurdles that they need to overcome for that type of issue. So that's what tends to be used. All right, international debt financing. Now, this is an outline of this particular area and the things that we'll be talking about within international debt financing. So first thing that I want to cover is standardised floating interest rates. We'll talk about intermediation versus disintermediation, and we'll talk about the factors that are going to affect the consideration of the choice of type of debt. What's going to drive that choice that we're going to make? And then we'll look at the actual sources of international debt financing. So there's euro currency loans, euro notes, and the international bond market. They're the different forms of debt financing that firms can use. Start here. Standardised floating interest rates. Okay. When a firm is issuing when a firm is issuing a security, or if a firm is raising debt capital, one of the things that's going to happen is you want to choose, do I want fixed interest rates, do I want floating interest rates? Now, if a firm is issuing a bond, well, they could just say, okay, the coupon rate on our bond is 8%, we'll issue those bonds, and if the face value is $1,000, and we'll make it nice and simple, if there's only one coupon paid per year, there's just an $80 payment each year, and at the end you get your last coupon and you get the face value back, and you sell that to the market. So it's a fixed income security. You know exactly you know exactly ahead of time what the payments are going to be. Now, what if the firm wants to issue a variable interest rate security? All right? Most debt financing that corporations issue is at the long end of the market, so it's in debt financing. There is other forms as well which we'll look at, but the majority of the financing is at the long end of the market. Okay? It's corporate borrowing, issuing of bonds directly to the market. Now, if they want those securities to be floating interest rates, well, now they're saying, okay, well, we're issuing a security, we're going to pay a variable interest rate on that security, and then we're going to pay the face value back at the end. So what is that variable rate? They don't just get to simply just pick and choose each period what interest rate they're going to pay, otherwise who's going to purchase the security? What they would do is they would tie the variable interest rate of their security to a reference rate. And that's what these are, standardised floating interest rates. So an example of that is LIBOR, okay, it's London Interbank Offer Rate, and that's the one which is primarily used for these types of issues. And so what that is it's the average rate that the top-tier financial institutions will lend to each other at. And it's an average of those. Okay, so top-tier financial institutions in the UK, what's the average rate that they will lend to each other at? Now, firms don't tend to be able to issue securities at LIBOR because they have more default risk than, say, a top-tier financial institution. And if that was the only interest rate that they were offering, then their securities would be priced would be relatively low. They wouldn't be able to raise much capital on that. So what they'll tend to do is they'll say, we will offer on our securities that we are issuing, we'll offer LIBOR plus 3%, LIBOR plus 4%, LIBOR plus 2%. Okay? And they tie that in ahead of time and then issue those securities. So there's some other examples. So LIBOR, so that's based on the offer rate. You can also have based on the bid rate. US prime rate is used in US capital markets, in Europe, Euribor, and in Asia, the Singapore Interbank Offer Rate. They're the primary ones that are used, although out of those, LIBOR is by far the most important out of all of those standard reference rates. Next concept that I want to cover here for debt issues. Okay, intermediation versus disintermediation. Now, intermediation, we raise capital through an intermediary. So think a bank loan. Okay, if I take out a loan from a bank, well, what's happened is the bank has accepted deposits from the providers of capital, and then the bank has lent those funds to me. So the bank is acting as an intermediary, and they charge a spread because they offer, say, on their deposits, they'll pay 1%, and then they'll lend to me at 4%. There's a spread between the two, and that's how the bank is. Making a profit off the two, and also covering their costs and their risk because they're taking on the default risk of the borrower. Now, that's intermediation through an intermediary. Disintermediation is when the ultimate provider of capital provides the capital directly to the borrower. Okay, so we take out the intermediary between the two. So disintermediation is, for example, when a corporation issues debt securities directly to the market and there's no intermediary standing between the two taking on the default risk. Now that, because we've taken out the intermediary who's taking a cut, it can reduce the cost to the borrowers, and it also increases flexibility. The corporations can issue whatever debt securities they want, as long as they can find someone who's prepared to buy those securities. Now, there has been a trend over time of moving from intermediation to disintermediation, okay, moving to a process where most borrowing from corporations is not through an intermediary. It's just securities directly issued to the market. And if anything, that's been encouraged by financial institutions, not discouraged. Okay? Financial institutions find it more profitable to not stand in the middle, because when they stand in the middle, they now have assets and liabilities on their books, and they're taking on a risk. Instead, if they provide a service which is bringing together the parties with excess capital with the parties that want to borrow capital, bring them together and receive a fee for the service that they are providing without putting their own assets and taking on liabilities, okay, it's more profitable for financial institutions to take that approach. So if anything, they've encouraged that move. Now, when a firm is issuing debt, here's some considerations in the type of debt that they would use. So broadly, they would look to minimise the after-tax cost of debt. Okay, broadly, it's a little bit more complex than that, because there is simply minimising the after-tax cost of debt does not necessarily minimise your overall cost of capital. And we'll look at the cost of capital, okay, in an upcoming week, probably about after the break. We'll look at the cost of capital specifically. But broadly, as a broad principle, when the after-tax cost of debt is lower, we would expect our cost of capital to generally be lower. And the reason it's not quite as simple as that is because sometimes taking on a whole lot of additional debt can actually affect the cost of equity as you take on more debt. So we have to think a little bit more about that later on. Firms would also want to consider currency matching. So that matching strategy is part of our risk management. We've thought about risk management before, and a part of risk management is matching your inflows and your outflows, and so matching your assets and liabilities in a similar denominated currency. Maturity matching is something that we'll want to consider. So matching durations of assets and liabilities. We'll talk about that as we go through. We want to think about fixed versus floating. What do we want exposure to? Do we want exposure to movements in interest rates or not? We'll think about forward hedging. We'll think about using parallel loans, and we'll think about our ability to swap if we have time today, if not next Tuesday. All right, so let's go through these. So first one there. Okay, so firstly, minimise after-tax cost of debt. Second one here is currency matching. So currency matching, matching our assets and our liabilities, managing our inflows and outflows, and if we know that if we're invoicing in US dollars, it might make sense using those receipts in US dollars to repay our financing in US dollars, because then only the residual needs to be converted back to Aussie dollars at the end. So we're financing in such a way as to reduce our overall cost of debt. Rather, I meant to say, we are financing in such a way so as to reduce our overall risk. Okay? We are matching our inflows and our outflows in the same currency, so we are controlling for foreign exchange risk simultaneously as raising capital. Remember when we looked at managing our competitive position, one of the things that the firm could do is they could look at what their operating structure was. Where do they invoice? Where are their costs incurred? But also a part of that was, where is our financing? And we're trying to set up the firm in such a way that the firm is less sensitive to movements in the exchange rates over time. Now, second point there, a subsidiary in a host country where interest rates are high. Well, it might be all well and good to say let's match our inflows and our outflows, but what if interest rates are relatively high in that overseas market? Okay, do we really want to do that? Because now potentially we're taking on a higher cost of debt and we're reducing risk. Is it now worth doing that or not? The one caveat I have on that particular point is think back to our equilibrium conditions. Okay? With the equilibrium conditions, we saw before that countries with high interest rates, their currency tends to lose value over time. So just because a country has high interest rates, does that mean that we should or shouldn't borrow there? Okay? Because if I borrowed overseas in a country with high interest rates and then converted it back, say, to the home, okay, over time, international Fisher effect. Over time, we'd expect the value of that currency to fall, and it makes the repayments lower over time. Now, that's in equilibrium. If you don't think you're in equilibrium, if you think, no, these rates are far too high, they're out of equilibrium, okay, it doesn't make sense to borrow there. But if you're in equilibrium, that argument doesn't necessarily hold. You can see here that bond yields among countries vary significantly, okay, across countries. And that's their point there in terms of where the interest rates are particularly high. You can see that they are significantly higher. My caveat to that, okay, think about the equilibrium conditions as well. Now, if you do have high interest rates, particularly if it's a developing country that we are using, that matching strategies, I've talked about this as I've gone through. Okay, I've already been through this as I've been discussing over the last few minutes. Okay, the matching strategy forces us to take more risk. Here's the example. So you have a subsidiary and you have a parent company with a subsidiary here in Mexico. One possibility for financing, I'll look at alternative 2 first, is just that the parent injects money directly into the subsidiary. But if they do, as that subsidiary generates funds, they need to repay the loan back to the parent. We're going to see a large transfer there. All of that is subject to foreign exchange risk. The amount that gets remitted back to the parent under alternative 1 with local financing is much lower. We see less risk there. Okay, next thing, debt maturity decision. Multinational has to decide what's the maturity going to be for the debt securities that they issue. Now, a part of matching strategy, that's matching inflows and outflows in the same currency. It's also worth considering what we do with our maturity. Okay, the concern is because interest rates in the short term are not necessarily the same as interest rates in the long term, and they don't necessarily move together. Okay, if we plotted out what short-term interest rates were and we plot what long-term interest rates were, okay, for example, there's been a lot of talk in the US just recently. Okay, they have an inverted yield curve. Okay, which is not a normal situation. Normally long-term interest rates are higher than short-term interest rates. Okay, interest rates for different maturities can be different over time. Let's see if there's an example of that. Okay, there's not there. Okay, so you could have like long-term interest rates 4%, short-term interest rates 2%. Which do you issue? Well, the 2% sounds nice. The problem for a firm is when you have your assets and liabilities which are subjected to, one of them subjected to long-term, one of them subjected to short-term interest rates. Okay? We could hold a lot of assets which are very sensitive to short-term movements in interest rates. We could have liabilities that are sensitive to long-term movements in interest rates. And if that was the case, what happens when the yield curve changes? What happens if there's a shift in the yield curve? We could find a situation with the shift in the yield curve, we could find our assets are falling in value at the same time as our liabilities are rising. So if a firm wants to manage that, okay, this is a risk. It's a risk of a shift in the yield curve. If a firm wants to manage that, it would make sense to match the maturities of their assets and their liabilities. And they do that through matching their durations, okay, of those securities. Now, next thing to consider, floating and fixed. Which do we prefer? Well, multinationals wish to use long-term maturity. They want to avoid the fixed rate, might consider using a floating rate bond instead, Exhibit 18.7. So here you have a firm and they've got their forecast of what the floating interest rate which is going to be applied to the loan is. So you can see there that if LIBOR's forecast at 3, if they take out a floating rate loan, they think 6 is going to be applied. So they're obviously paying LIBOR plus 3%. The reference rate plus 3% over the life of this loan. Now, they could take a floating loan or they could just take a fixed loan. But what we're now doing is a comparison between the costs under fixed financing and the costs that you can see here under floating financing. Which does the firm prefer? Now, we would, in terms of making that choice, okay, and in terms of changing between them, we're going to look, we should have time. Okay, we're going to look at how firms can change their position. But certainly from one to the other, we're going to look at that through a mechanism called swaps. But there is also the fact that if we are just issuing the security in the first place, so at the time of the initial issuance of the security, we need to make that choice. Do we think that interest rates are going to be rising over the next period of time? And if we do, we might want to avoid floating interest rates. Maybe we want to lock in the fixed interest rates right now when we think that they're quite low. Okay, if you're concerned about rising. Or alternatively, if you think that interest rates are falling, maybe we want to be exposed to that, so we're going to, at this point in time, issue floating interest rate securities. Now, the more difficult issue for firms comes when they've already issued those debt securities. How do you change from one form of interest to the other form of interest? And we'll see that a bit later. Okay. This slide I have given you before, but I just wanted to point out that at this point earlier on in the course, when we were looking at managing the competitive position, okay, one of the things that we said in terms of managing their operating position there, they could change the firm's, well, they could change the operating policies, but they could also change the financing policies of the firm. And I talked at that point in time about natural hedging, using forward contracts and debt, diversifying. I also talked about parallel loans and currency swaps, but we didn't really go through them in any great detail. So let's have a look at parallel loans now, okay? But it relates to this point earlier when we were talking about setting up the firm, just referring back to that earlier lecture. So, parallel loans. We can use parallel loans to execute a matching strategy. We're trying to match inflows and outflows in the same currency. Now, if you have a multinational and we can't borrow in a currency that matches our invoice currency, then one of the things that we can consider is using a parallel or a back-to-back loan. Two parties there, you can see they are agreeing to provide simultaneous loans with an agreement to repay, and that will be useful if our inflows and our outflows don't match, and we're worried about that. Here's an example. Here's an illustration of it. So you have here a US parent company and a British parent company. They have subsidiaries or they're setting up subsidiaries. One or the other doesn't really matter. But the subsidiaries need capital. Okay, the UK subsidiary of the US parent needs pounds. The US subsidiary of the UK parent needs US dollars. These two parent companies can agree to lend to the other company's subsidiaries the funds that they need. This is a parallel or a back-to-back loan. That's what we're seeing here. So why that's useful then is because now the subsidiary, okay, in the UK gets the pounds that they need, but also if they've got inflows, they are now repaying a pound loan. So it's not subject to foreign exchange risk. So what we're doing is we're executing or pursuing the matching strategy here. Now, with a parallel loan, parallel loans, okay, they can be useful for pursuing the matching strategy. There are some weaknesses with parallel loans. Okay, this type of arrangement isn't that common. When this type of arrangement first began to be set up, what would happen was financial institutions had different clients, and financial institutions recognized that their clients had essentially the opposite needs of each other. Okay, you had a US firm that needed ringgits, you had a Malaysian government needed US dollars. The firms could arrange a parallel loan between the two. Now, the problem with this type of arrangement, there's a few. The problem with this type of arrangement is, firstly, how do you find that other party? It's very difficult to find the other party. You need someone who needs the opposite position to what you need at the same time and is prepared to enter into that arrangement. It can happen, and financial institutions can help to facilitate this arrangement, but even still, it's difficult to find the partner. Secondly, in this type of arrangement, what happens in the event of default? Because we have two loans here. And if one of these subsidiaries defaults to the parent, and if these loans are made in two different markets, there are jurisdictional problems in terms of what happens. If one of those loans default, does the other subsidiary still need to repay? Okay, so there are legal issues of concern here. And the third issue is what happens to the balance sheet when you take this type of arrangement. Because you think about it from the group's perspective. Okay, you have a US parent and it has a UK subsidiary. And what happens is the US parent now has an asset and the subsidiary now has a liability. So what happens to the balance sheet? Assets go up, liabilities go up, equity stays the same. So debt to equity ratios rise for the group as a whole. And debt to equity ratios have an impact on a firm's ability to raise capital in the future and the types of rates that they can get. And often there are debt covenants, there are restrictions in place of the type of put in place on the debt to equity ratios that firms can have. So there's a negative impact on the debt to equity ratio here because there's no change in equity. It's just assets rising and liabilities rising. So over time, firms have gravitated towards swaps, and swaps are what are now used in financial markets. And when you look at we'll see it on the next slide. But on the next slide, we'll see, I'll jump here first. When you look at swaps in the entire derivatives market, okay, so this is every 3 years, this gets published by the Bank of International Settlements, so at the end of this year, they'll do the next one, we'll be able to look at the 2019 figures. But interest rate derivatives, okay, 438 trillion, this is USD, this is outstanding contract values. Of all of those, interest rate swaps make up 327 trillion. 60% of the entire derivatives market is interest rate swaps. Okay, so when you think of derivatives, people tend to think in terms of options, futures contracts, okay, forward contracts, okay, we've got lots of different derivatives here. Credit default swaps, equity linked contracts, there's lots of different forms of derivatives. The entire derivatives market, 60% of it are swaps. Okay, it is an exchange of fixed interest payments for floating interest payments. So you have to think about swaps. Okay, so what is a swap? So swap, an interest rate swap, whether it's an interest rate swap or a currency swap, so there are two different types of swaps, is a transformation. It's exchanging one stream of payments for another stream of payments. That's what we're doing here. Okay? So swaps, okay, we transform the nature of our liabilities and our assets. If it's an interest rate swap, the firms are agreeing to exchange interest rate payments based on a fixed interest rate. We exchange that for a floating interest rate. And if it's a currency swap, it's an agreement to exchange one currency for another at a specific exchange rate and date. Now, a currency swap includes a principal, an interest rate swap doesn't include the principal. Okay, there's no point two firms getting together, firm A and firm B. We get together and we arrange a swap, and I'll give you the principal of $1 million and you give the principal of $1 million back to me. Okay, we don't exchange principal. It's an exchange of the interest payments based off a notional principal. With a currency swap, there is an exchange of principal. Okay, you're exchanging one currency stream of payments for another currency stream of payments. So there does tend to be a principal exchange at the beginning as well of one currency for the other currency. And of course you can do a combination. You can have a currency and an interest rate swap. And intermediaries are normally involved in this type of transaction. So the reason that firms use interest rate swaps, one, to hedge their interest rate risk. They're worried that interest rates are going to rise, so they want to get out of their floating interest rate securities and into fixed interest rate securities. Maybe they want to take a position in interest rates. Okay? Maybe they want an exposure to the movement. So they're making fixed payments, but they want an exposure because they think interest rates are falling. They want exposure to that. They think their interest burden is going to fall in the future based on the forecasts that they have. So they're trying to take a position. Another possibility is to reduce the cost of debt if there are market imperfections. So when there are market imperfections, firms can overcome those using a swap. And I'll give you an example of how that works. And it allows the construction of longer horizon hedges. Because when a firm wants to hedge, they want to remove risk. We've seen earlier in the course, in terms of managing risk, we can use derivative contracts to manage our transaction exposures. The problem with using derivative contracts is that eventually our derivatives run out. If we try to use derivative contracts to manage our risk in the long term, okay, eventually our derivatives run out, and the prices of those derivative securities will move over time. You can't keep protecting yourself indefinitely using derivative securities. And certainly for long-term derivative securities, we just simply can't get the instruments that we want to engage in long-term hedging. Now, swaps are based off corporate debt. The long end of the market, for example, corporate bonds, often have durations of 25 or more years. And now we can create hedges based off these long-term streams of payments. And so, if you're worried they're going to rise, we can swap fixed and floating. Institutions will often act as dealers in those, and a vanilla interest rate swap is based off a notional, and you are just swapping fixed for floating, and I will just do this last slide here. Okay, this is what's happening. Two firms getting together. And what's happening here is that the quality firm is making a payment to the risky company, a variable interest rate payment. They already had fixed interest financing in terms of their bonds, but they agree to exchange variable for fixed. If you think about this, from each firm's perspective, they now have 3 transactions. Okay, so quality is receiving fixed and paying fixed. So they're receiving fixed to pay their fixed, but they are having to pay variable. The net effect is that they've moved from fixed to variable borrowing. And the risky company had variable financing, but they have swapped it to fixed because they're now receiving the variable financing to cover their variable loan from the bonds that they've issued, and now they have to make fixed payments instead. That's how a swap works between these two firms. All right, that's that there. Remember the assessment next week, and I'll continue from this point next Tuesday. All right, all the best, guys.